Hello, welcome to our revision session once again. This is Advanced Taxation class, and this time round we are looking at the August 2022 sitting. So be ready, have your calculator and other materials, and let's break down the numbers together. So just a few tips before we start. Number one, in a real exam situation, take your time to go through the paper. Spend the first 10 minutes or so. Go through the entire paper to do what you call question ranking. In other words, look at each and every question in details. See which questions are the easiest for you, and start with your best question and finish with your worst question. So if, for example, question 1 is testing on something you may not be very familiar with, you are free to make it your question 2 or 3 or even 5. So what you do in short, look at each question keenly, determine how many marks you are sure of from each question, then start with the question that will earn you the highest number of marks. Finish with that which will earn you the lowest number of marks. Of course, in this session, we shall look at each question in details and we shall answer all of them. Again, as you answer questions, please be very consistent. Like each question will have 2 or more parts. Like say it is question maybe 3, and question 3 has part A, part B, part C, and all that. So what I mean is, do not answer part B or C, for example, before you are done with part A of the question. So be as consistent as possible. Normally, if you answer a part, a higher level part before you finish with the lower one, the assumption is the answers you're presenting are for the first part, so you are likely to fail because of that. So do your analysis keenly, be very consistent with the questions, and make sure you answer each and every part of the question keenly. Maybe we shall use this session to illustrate some of these tips so that you are able to sit the exam once and for all and be able to pass and move to the next level. So in this session, we shall look at the August 2022 paper. And maybe to illustrate what I'm talking about, we can go through the paper. You are even allowed to start with the last question if you think it is your best question. So maybe to illustrate that, I'll want us to go through the entire paper. Assuming you've done your analysis and say your question, your best question is question 5, just as an illustration. So go through question 5, be very consistent with the parts, and make sure you do each and every part keenly. So assuming that is the case, allow me start with question 5 of the paper. So question 5 has 3 parts, that is part A, B, and C. Part A and B are theory questions, then part C is a computation question. So part A says, a recent publication from a leading international advisory group opines that of all forms of tax incentives, tax holidays are the most popular among developing countries. A recent publication from a leading international advisory group opines that of all forms of tax incentives, tax holidays are the most popular among developing countries. Required, discuss 4 limitations of tax holidays in developing countries. Discuss 4 limitations of tax holidays in developing countries for 4 marks. Now, first, please understand the origin, the background of the question. The question being tested here is on tax holidays. So first of all, you should know what tax holidays are. There are possible advantages and disadvantages, which is the question here, and every other thing about that. Now, just to start us off, there are various forms of tax incentives that a government may offer to its taxpayers. Now, most common among these are tax holidays. So tax holidays are basically exemptions from taxes for given number of periods or tax periods. A good example is what you have in the case of EPZ enterprises. In Kenya, for example, EPZ enterprises enjoy tax holidays for a given number of years, that is 10 years to be particular, for the first 10 years of the operations. So yes, they operate and make income from the operations, but the government allows them not to pay taxes on such income. So then we say they enjoy tax holidays. So tax holidays, in short, are simply exemptions from taxes for a given number of periods. So the question is, discuss 4 limitations of tax holidays in developing countries. Now, when answering such a question, number 1, please have what we call an introductory statement. An introductory statement is simply a statement introducing what you want to talk about, and where you are told to explain a concept in relation to your country. Then the next thing is, please identify that country. For example, here we have been told to explain the limitations of tax holidays in developing countries. So in this case, it is in respect of developing countries. If they ask you to do so, maybe in relation to your country, then our country being Kenya would do so in relation to Kenya, to be particular. So then, just as an illustration, you can have this kind of introductory statement. I'll write this for purposes of illustration. So we are answering question 5, part A. So you can say, for example, the following are the limitations of tax holidays in developing countries. So that is an introductory statement. Then you can now start explaining the limitations one by one. In mathematical papers like taxation, you're allowed to number your points. So one, you can say, for example, tax holidays reduce tax revenue to the governments of developing countries. Now, the ultimate result of tax holidays being a tax incentive is it will reduce the amount of revenue that the government will be receiving from taxpayers for a particular period. So what is the effect of that? You can go ahead and say, for example, this may force such governments to raise more revenue, more income from other sources, such as maybe public borrowing, which overburdens their taxpayers. So, say for example, the government of Kenya decides to extend tax holidays to a number of sectors in the economy. That would mean that the tax revenue the government will be collecting would be low. So to finance its activities fully, the government may have to borrow, for example, from other organizations or other governments. So what does that mean? It means the Kenyan taxpayer may be overburdened with the interest and all that on the borrowed funds. So that is one. Number two, you can say that tax holidays are prone to abuse by investors. For example, investors may close up their businesses and enter into other operational arrangements with those enjoying the exemption. This further reduces government's revenue by encouraging tax avoidance. Now, this is what I mean. Say, for example, company A is enjoying tax holidays for the first 10 years of its operations. And company B, being aware of that, what they do is to enter a partnership so that, for example, company B transfers its operational activities to the company A that is enjoying the tax holidays. So what does that mean? Through that such transfer pricing activities, this company will be avoiding taxes, not evading, avoiding taxes, so that the government will be receiving less and less in terms of tax revenue. Number 3, you can say time-bound tax holidays may encourage short-term or short-run investments which may not benefit the developing countries as long-term ones or long-run ones. Now, this is what I mean. Say the government of Kenya is granting tax holidays for given companies in given sectors for maybe 5 or 10 years. So what will that mean? Investors may come to Kenya, invest in Kenya for the 5 year, 10 years or so, just to enjoy the tax holidays. Then after that, they stop the operations and go elsewhere. In that case, such a short time of investment in the country will not benefit the country so much like those long run projects or long run investments which are in other countries. Number 4, you can say, for example, that tax holidays may be expensive to the governments. Tax holidays may be expensive to the governments of developing countries, especially where the investors or the taxpayers have to file their tax returns every year. Now remember, this is against nil revenue. So the government is spending so much to administer the tax holidays, but receiving nil revenue. So that may mean that the government will be losing so much because of the expensive exercises. Say, for example, this is against nil revenue from such taxpayers. So say, for example, this may be agricultural companies or EPZ enterprises enjoying tax holidays for 10 years. So the government will have to spend much to administer the tax holidays and ensure that these investors comply with the regulations. But remember, it is receiving nil revenue from such investors. So that may mean that tax holidays may become very expensive to administer in developing countries. You can go ahead and explain more and more, but in an exam situation, you may not have to explain so many points. Just explain the required number. In a revision session like this, you can have as many points as possible. Maybe you can add one that the duration of tax holidays is prone to abuse and extension by investors through creative redesignation of of their investment. So this is what I mean. For example, a company A has maybe 5 investors in it or shareholders. So they are investing in Kenya for 5 years or 10 years and enjoying the tax holidays. Then what they do is that at the end of the tax holiday period, they reorganize the company or the project or the investment, start a new project, and pretend that they have abandoned or cleared with the first project just to continue enjoying the tax holidays. And you see, through such, the government keeps losing so much tax revenue, which at the end of the day will affect the government's operations. So they can be as many as possible. In an exam situation, pick your best points, explain them properly, and you don't have to explain more than required, because you may be eating into the time required or rather to be used in answering other questions. So that could answer part A of question 5. Know what a tax holiday is, advantages of tax holidays, disadvantages of tax holidays, know how the tax holidays are granted to companies, or rather which investors or which sectors of the economy enjoy tax holidays and for what period in your country. Part B of the question says, it's still a theory question. In the recent months, the Revenue Authority reports have indicated achievement of tax collection targets. In the recent months, the Revenue Authority reports have indicated achievement of tax collection targets required. Explore the factors that might have led to this achievement. Explore the factors that might have led to this achievement for 4 marks. Now, the non-achievement of tax collection targets, like say KRA in Kenya for the financial year 2022-2023 targets to raise maybe 2 trillion shillings in terms of tax revenue. Now, the achievement or the non-achievement of that will depend majorly on 2 factors. One is the level of tax evasion in the country, and 2, the level of tax avoidance in the country. So any measures to curb, rather to minimize the level of tax avoidance and tax evasion in the country would help achieve tax collection targets in any country. So here we are asked to explain any 4 factors that might have led the achievement of tax collection targets in Kenya by our Revenue Authority. Of course, our Revenue Authority in Kenya is the Kenya Revenue Authority. So again, being a theory question, one have an introductory statement. So you can say, for example, the following factors might have led to the achievement of tax collection targets by the Revenue Authority in Kenya. The following factors might have led to the achievement of tax collection targets by the Revenue Authority in Kenya in the recent months. You should also include the period. As you frame the introductory statement, be guided by the words of the question. So let me pick it again. You can say, the following factors might have led to the achievement of tax collection targets by the Revenue Authority in the recent months, something like that. Then you can explain your point. So you can say, for example, there are many factors. One is about heavy penalties on tax evaders. Heavy penalties on tax evaders. Now, this is what we mean. In the recent past in Kenya, we have seen the Kenya Revenue Authority imposing very heavy penalties on those found guilty of tax evasion. What has been the effect of this? This has discouraged tax evasion to a great extent, and so the Revenue Authority has been able to collect more, and therefore that has contributed to it achieving its tax collection targets in the recent months. Another factor could be the reactivation of what we call the KRA call center or customer care center. For example, if you are a taxpayer in Kenya, in the recent past you may have noticed that KRA call center or customer care center has been so consistent in reminding taxpayers, for example, to pay their taxes as required, to file their tax returns and all that. So that has kept encouraging taxpayers to do what is required and comply with the tax rules and regulations. And because of that, KRA has been able to achieve its tax collection targets. Number 3 is about the collaboration of Kenya Revenue Authority with other stakeholders like the financial institutions like banks, employers and all that. In the recent past, if you are keen, for example, you cannot open and even operate a bank account without supplying your KRA details. Why? Because KRA works together with such institutions just to ensure that all taxpayers comply with tax rules and regulations. So you go opening an account in a bank, the first thing they'll ask you is your KRA PIN. Why? So that any transaction that earns you any income from that particular bank will have to be captured by the KRA system. So that has ensured that there is total compliance by taxpayers, and therefore KRA has been able to achieve its tax collection targets. Another one could be the modernization of the tax system. Now, if you are keen, for example, in the recent past, you don't have to go and queue at KRA halls to pay your taxes or file your tax returns, or go to banks to, be bothered by the long queues at the banking halls and all that. You can file your tax returns, you can pay your taxes from the comfort of your home or your office. Just with systems like iTax and all that, you can pay your taxes as required on time without much straining. Those must be 4. Another one could be about increased taxpayers' education through programs like tax clinics. If you are keen, for example, KRA has been very keen to educate taxpayers on factors like importance of paying taxes, how to pay taxes conveniently, when to pay such taxes and all that. If you are keen in Kenya, anytime you switch on your TV, you'll always see some advert, or rather some message from KRA reminding you on how to go about your tax issues and all that. So that has encouraged taxpayers so that people are able to pay their taxes as required from the comfort of their homes and offices, and that has meant achievement of the tax collection targets by KRA. So those could be some of the factors which might have led to the achievement of tax collection targets by the Revenue Authority in the recent months in Kenya. And that is question 5B. I move to question 5C, which is now mathematical. It says, John Malley has been trading as a sole proprietor for the past 4 years. The Revenue Authority suspects that the business has been involved in tax fraud since it commenced operations. John Malley has been trading as a sole proprietor for the past 4 years. The Revenue Authority suspects that the business has been involved in tax fraud since it commenced operations. The firm has submitted the following records since its operations from 1st January 2018 to 31st December 2021. So we have a list of assets, liabilities, and additional information 1 to 4. Required: determine the taxable income of John Malley for each of the 4 years ended 31st December 2018, 2019, 2020, and 2021 for 12 marks. Determine the taxable income of John Malley for each of the 4 years ended 31st December 2018, 19, 20, and 2021 for 12 marks. Now, this question is from the topic we call tax investigations in advanced taxation. Now, it is testing what we call preparation of capital statements. So that reminds you, number 1, know what a capital statement is. Number 2, know the circumstances under which capital statements are prepared. Number 3, know the steps involved in preparing capital statements to determine taxable income for past periods. Just a quick reminder before we do the actual question. In tax investigation, if KRA suspects that a taxpayer, for example, has been involved in tax evasion, then they have to they have to determine the actual taxable incomes of such a taxpayer for the tax period under investigation. Say, for example, KRA suspects that you've not paid the correct amount of your taxes for the past 5 years. So what they will do is to determine your actual or your true taxable incomes for each of those past 5 years, then they will advise you on the correct amount of tax you should pay. There are two ways of doing that. Number one is by reconstruction of financial statements, that is, preparing the financial statements afresh to determine your actual tax liability. Number two is preparation of what we call capital statement. Now, the first method has a limitation in that normally the taxpayer may not have adequate information to help KRA prepare reconstruct such financial statements. So that means the second method comes in handy, and that is what we call preparation of capital statements, and that is what the question is testing here, a very common exam area. So here, in short, we have to prepare a capital statement for each of the for the 4-year period to work out the taxable income. This is what we do. So we are answering question 5C. The taxpayer in question is John Mali. So we write here John Mali. We are preparing capital statement. Capital statement for the period. For the period or rather we can say for the year. In this case, the periods are in years. Let's say for the year 2018 to 2021. So we have January 2018, so we write here 1st January 2018. We have 31st December 2018, 31st December 2019, 31st December 2020, and 31st December 2021. You must show the currency that you are using. Good. So we shall also use this question to help us learn the steps involved in preparing capital statement. So one, we get the assets of the taxpayer for each of the periods. So be very keen. Again, in preparing capital statements, we use both business and private items. That is both business and private assets and liabilities. The assumption is the taxpayer has mixed up issues and it is not possible to separate his personal assets or items from business items. So because of that reason, we put everything together. So when we have business premises, that is an asset. Business premises 2018 January 144 million 160 172 152 and 160 million. 2, we have plant and machinery. Plant and machinery are assets 68 million 72 87 82 and 92. Next we have motor vehicles, still an asset 22 million 24 million 24 again 26 and 24. Next we have inventory, still an asset 9 million 11,200, 16,200, 22 million, and 14,800. Trade receivables are assets, 76,90, 86,30, 8,600, 7,800, and 82. Next we have private residence is an asset. Private residence is asset 1. We have 16,400, 32,400, 32,400 again through trade payables are liabilities, bank loan liability, loan from a friend liability, mortgage loan liability. Then you have cash. Cash is an asset. 7,400, 96, 78, 8260, and 8840. That is all in terms of assets. So what we do is to get total assets. For illustration purposes, we can mark it A. In the exam, you may not have to mark it because you'll be sure of what you are doing. Here, I'm marking it because I want us to understand each step at a time. So we get the sum of each column. I'm here, 2018 January. We have 144 plus 68,000, 22,000, 9,000, 7690, 16,400, and 7,400. I'm getting 274, 490. You can do it with me so that you confirm. Yes, 274, 490. 2018 December, 160,000, 72, 24, 11,200, 8630, 32,400, and 9,600. I'm getting 317, 830. 2019, 172, 87, 24, 16,200, 8,600, 32,400, and 7,800. I'm getting 348,000. 2020, 152, 82, 26, 22, 7,800, 32,400, and 8260. I get 330, 460. Lastly, 2021, 160, 92, 24, 14, 800, 8,200, 32,400, and 8840. I get 340, 240. That is step 1. Step 2 is to get liabilities. So we write here liabilities. So we list all the liabilities, again, both private and business. So one, we have trade payables. Trade payables. 2018 January, we have 14,900. Next is 19,200, 2,400, 2,400, 18,100, and 15,200. Next we have bank loan, 22,400, 21,800, 19,400, 7,900 and 18,900. Next we have loan from a friend. Loan from friend. A loan is a liability. 1580, 1320, 1180, 1690, and 1020. We have mortgage loan, still a liability. This is 7,800. It's 7,800 all through. Yes, and if you are keen, that is the last liability we have. So the next thing we do is to get total liabilities for each case. Total liabilities. We can mark it B for illustration purposes. So we move together. Here, 2018 January, we have 14,900, 22,400, 1580, and 7,800. I'm getting 46,680. Next, 19,200, 21,800, 1320, and 7,800. I get 50,120. 50,120. Next, 20,400, 19,400, 1180, and 7,800. I get 48,780. Next, 18,100, 7,900, 1690, and 7,800. I get 35,490. And lastly, 15,200, 18,900, 1020, and 7,800. 42,920. 42,920. 42,920. The next step now is to get capital or net worth. So we do it like this. You say net worth. Now here we are applying what we call accounting equation. Accounting equation is total assets A equals to total capital plus total liabilities. So we say A equals to C plus L. That is total assets equal total capital plus total liabilities. So if you are keen, we have total assets, we have total liabilities. So the difference between the two will give us the capital of the firm, or what we call net worth. So net worth is simply here A minus B. That is why I was marking them like that. We move 2018 January, 274,490 minus 46,680. I get 227,810. 317,830 minus 50,120. I get 267,710. Next, I have 348,000 minus 48,780. I get 299,220. Next, 330,460 less 35,490. I get 294,970. And lastly, 340,240 less 42,920. 297,220. 297, 320. The next step now is to get what we call change in net worth. I'm moving here. Change in net worth. So just to continue, we have January 2018, December 2018, December 2019, December 2020, and December 2021. So we get what we call change in net worth. Change in net worth, that is change in capital. Now capital can change as a result of four factors. One is profits or income, two, losses, three, additional investment, and four, withdrawal. So what we do is simple. Like we have 2018 here, December and January. So what we do is this. We compare the capital of the firm as at 2018 December with that capital as at 2018 January. The difference between those two figures will give us, will tell us what happened during this particular year. So we start with 2018. So here will be dash. So for 2018 we shall have 267, 710 less 227, 810. I'm getting a difference of 39,900. 39,900, yes. 39,900. 2019, sorry, will be 299, 220 less 267, 710. I get 31, 510. 2020 will be 294, 970 minus 299 to 20. I get negative 4250. 4250, but negative. And lastly, we have 297, 320 less 294, 970. I get 2350 positive. Good. So in short, it means for each of the years, these were the profits made, except for 2020 when there was a loss of 4250. The next step now is to adjust the profits made during the year. So that is where we shall use the additional information. So we move to adjustments. So we say, first we can say add back. We add back whatever should be added back. Then we shall deduct whatever should be added deducted. So move to information information 3. Information 3 says his personal expenses for each of the 4 years were as follows. His personal expenses for each of the 4 years were as follows. Now personal expenses are not allowable expenses for business purposes. So the assumption here is this taxpayer used business money to meet his personal expenses, and because such are disallowable expenses, we shall have to add them back so that we determine the correct profit for each of the year. So we write here, add back 1, personal expenses. So 2018 is 162,400. Remember we are carrying 3 zeros here, so this will be 162.4. 2019, 296,000. 2020, 178, and 2021, 340. Another item to be added back. Now, information 4 says we ignore capital allowances. Now, we know capital allowances are deductible instead of depreciation. If you look at these assets, we have plant and machinery, for example, here. Plant and machinery is prone to depreciation. So, instead of depreciation, we should have deducted capital allowances. But information 4 says we ignore capital allowances. We have information 2, which says interest on mortgage was at a rate of 15% per annum on reducing balance basis. The maximum mortgage interest allowed is 300,000 shillings per annum. Interest on mortgage was at the rate of 15% per annum on reducing balance basis. The maximum mortgage interest allowed is 300,000 shillings per annum. Now, there's a liability here called mortgage loan, which is 7.8 million shillings all through. And we are told in note 2, the interest on this loan was at 15% per annum, though the maximum interest on mortgage allowed per annum is 300,000. So what we do is simple. It can only be an allowable expense if the mortgage was for business purposes. So for us to adjust these incomes with this interest, we have to make an assumption. So that means we write notes and assumptions. So write notes and assumptions. One, we say the mortgage loan is assumed to have been for business purposes, hence the mortgage loan interest is allowable. Again, you can write the mortgage loan is assumed to have been for business purposes, hence the mortgage loan interest is allowable. And we are told it is at the rate of 15%, so we do 15% of 7.8 million, which is 1,170,000. But note 2 says we only allow a maximum of 300,000. So here we come and say less 1 mortgage loan interest. So we cap it at 300,000. So we say 300,000, 300,000, 300, and 300. Information 1. During the year ended 31st December 2021, a motor vehicle was disposed of for 2.6 million. The cost was 2 million shillings. What does that mean? It simply means the firm made a profit from disposal of this motor vehicle. So what was the profit? We have the disposal of this sales proceeds of 2.6 million and cost of 2 million, meaning the gain was 600,000. So we write here, gain on motor vehicle disposal or sale, and it was for 2021. So we write here 600. And lastly, we have information. We have this item called loan from a friend. Now, loan from a friend is not a business item. Again, it is not a taxable income. So because of that, we deduct it to this point. So we write here loan from a friend. 1580 loan from a friend is 1580 in 2018 January, but 1320 here. If you're keen, I'm ignoring January 2018 because we are not using it anymore. 2019 1180, 2020 1690, and 2021 is 1020. And with that, we now get what you call taxable income for each of the years. So taxable income. So taxable income is simply the change in net worth, then we add and deduct the adjustments for each case. So we do it for each year. So let me start with 2018. That is 39,900 plus 162.4 less 300 less 1320. I get 38,442.4 positive. 2019, I have 31,510 less 300 less 1180. I get 30,030. 30,030. 2020, we have negative 4250, we less 300, less 1690. I get 6240 negative. And lastly, we have 2350 plus 600 less 300 less 1020. I get 1630 positive. And what was the question? The question was determine the taxable income of John Malley for each of the 4 years ended 31st December 2018, 19, 20, and 21. And that is what we have done. A question could also be asked, this question could also be asked differently. They could ask you to determine the cumulative taxable income of John Malley for the 4-year period. In that case, once you reach here, simply get the sum of each of the sum of all these figures. And with that, we have answered part C of question 5, and that is the end of question 5. Take your time once again, go through it and do more questions touching on these areas of capital statement and even the theory part that we've covered.